Hello and thank you for your time in watching this video. In this video, I'm going to talk about 7 key ratios which are important in analyzing any mutual fund. I've tried my level best for keeping this video as entertaining as it could be, and for doing that I've added a good music because the content itself can be a little boring. These ratios are too financy, and I hope you enjoy it. However, for any reason if you don't like it, then just skip the whole video and go in the end where you will see a small summary which I've prepared about what this benchmark ratio should be. Hopefully that would be very helpful when you analyze a mutual fund. And if you've liked it, please do subscribe it and do comment anything which you would like me to improve on this video, or anything which you would like to learn about mutual funds. I'll be very happy to do some research and present a good video about it. So let's deep dive into it now. Good luck and happy investing.
So let's go through them one by one. The first one is alpha. What does alpha do is, alpha checks how much is the fund generating excess return as compared to its benchmark, right? So it checks excess returns as compared to its benchmark. Now, if we think logically, we want the fund to generate as much excess return as it can. Therefore, higher is always better. So look for a higher alpha. Higher is better. Then the second thing is you will be looking at is information ratio. What does information ratio do? It checks how consistently is the fund generating alpha. Means how consistently is the fund generating excess returns over benchmark. So it checks for consistency. Generating higher returns. Again, if we think logically, we need it to be very consistent, hence higher is better. Then the third one is standard deviation. Standard deviation measures volatility, and volatility is risk. Therefore, standard deviation measures risk, right? So measures risk. Logically, if we think logically, we want less riskier fund. So always look for lower is better. Then comes this Sharpe ratio. What does Sharpe ratio do? In the simplest terms, all what Sharpe ratio does is it checks how much of the risk you took is converted into return. That's all it does. So how much of the risk is converted into returns? We want as much as it can. Therefore, higher is better. Then comes this Sortino ratio. Now, see for example, if your fund is behaving like this, right? Now, from a Sharpe ratio's point of view, can you see all these positive abnormal returns are also riskier as much as the negative abnormal returns are. So Sharpe ratio considers this and this, both risks, positive and negative both. Anything which is abnormal is risk for Sharpe. But what does Sortino do is, it only considers the negative abnormal returns as risk, because what Sortino says is positive abnormal returns are always welcomed by an investor. So it just checks for the downside volatility. Higher is always better. Why is higher the better? Because the formula for calculating Sharpe or Sortino is one thing, is risk premium divided by standard deviation. This is Sharpe ratio. And Sortino does is downside risk premium divided by downside standard deviation. This is Sortino formula. What is a risk premium? Say your mutual fund risk is generating a 5%, but the risk-free rate, say a government bond, is generating 3%, then your risk premium is 2%, and the standard deviation is whatever. Now, in this case, say for example, your risk premium is 25 and your standard deviation is 5. Downside standard deviation is 5. So what is the answer here? 5. So this is your Sortino. Now, instead of the 5, say for example, your downside deviation was 10. Then what is your answer? 2.5. Now, technically, Sortino is less. Why? Because this is high. Downside standard deviation is high. Therefore, Sortino is low. But when your downside standard deviation is low, your Sortino is high. Therefore, you need a higher is better. Then the next one is beta. Beta checks how sensitive or volatile is your fund as compared to benchmark. So it checks the volatility or sensitivity of the fund as compared to its benchmark. Now, say for example, your beta is 0.65%, and if the benchmark falls down by 1% basis point, then your fund would only fall down by 0.65%. But if your beta was 1.25%, and if your benchmark falls down by 1% basis point, then your fund will fall down by 1.25%. This is not good. Always look for a lower beta. This is good when the benchmark moves up. It will move up by 1.25, but equally it will wipe out your returns by 1.25% when the market falls down. So always look for a lower is better. And then comes is the R-square ratio. What does R-square ratio do? It checks how much of the fund, how much is your fund following the benchmark in terms of pattern, right? So how much of the fund follows the benchmark in terms of pattern. Now, like the other ratios, for R square, there is nothing like a higher is better or a lower is better. It depends, but what happens is generally when it's an index fund, if it's an index fund, your R square will be high, because index fund has to replicate the benchmark. That's what the index fund does. But if it's an active fund, actively managed fund, you expect the R square should be low. Why? Because active fund, you are expecting the fund manager's creativity to generate extra alpha return. You expect the fund manager's creativity to generate alpha. Sorry. Right. Now, if you ever come across a situation which you would when you start analyzing funds, with an active fund, you have a higher R square, which is a red flag. Why? Because what it indicates is you are investing into an active fund, taking more risk, paying more expense ratio, but it's just replicating the benchmark. Better off you invest into an index fund where you get set amount of return and you have and it is less expensive, right? So let's summarize these 7 ratios. So first is alpha. What does alpha do? Checks excess return over its benchmark, and we need is higher alpha. Then comes this information. Checks how consistently is the fund generating alpha. Checks consistency of again we need higher one. We need a higher consistency. Higher is better. Then we need standard deviation, measures risk, and risk always we need is to be less. It always needs to be less, so lower is better. Then we need is Sharpe ratio. How much of the risk you took is converted into returns. So risk is converted into returns. Higher is the better. Then comes this Sortino. How much of the downside risk is converted into returns? So downside risk converted into returns. Again, we need higher is the better. Then comes this beta. What does beta do? It checks the sensitivity to benchmark. Now, the general rule is when the beta is equal to 1 means exactly like benchmark. When it is less than 1 is equal to less sensitive as we checked, and if it's more than 1 then means more sensitive. And then is information ratio. Is the R square ratio. Checks how much of the fund follows the pattern of the benchmark. Now, if it's an index fund, we need higher R square, but if it's an active fund, we need lower R square. But if it's an active fund and the R square is high, it's a straight no. I hope you've liked it, and if so, please do follow me. Thank you.